Regulatory framework for financial reporting. Understanding the regulatory framework of financial reporting is essential for anyone studying ACCA Financial Reporting, FR, or working with IFRS standards. This section explains the rules, bodies, and enforcement mechanisms that ensure financial statements are consistent, transparent, and reliable worldwide. 1. Why do we need a regulatory framework? A regulatory framework sets the rules for preparing financial statements, ensuring that businesses report financial information consistently and fairly. It prevents misleading financial practices and protects investors, lenders, and other stakeholders. Key objectives of the regulatory framework. Ensures transparency. Financial statements should provide a clear and accurate picture of a company's performance. Enhances comparability. Users can compare financial reports across different entities and time periods. Protects investors. Reduces the risk of fraud and manipulation. Supports global trade. Standardized reporting improves cross-border investments and business operations. Without a regulatory framework, companies could manipulate financial statements to mislead investors and creditors, damaging trust in financial markets. 2. Key organizations in financial reporting regulation. A. International Accounting Standards Board, IASB. The IASB is an independent body responsible for developing international financial reporting standards, IFRS. It was established in 2001 to replace the International Accounting Standards Committee, IASC. IASB's role. Develops and updates IFRS standards. Ensures that IFRS reflects modern business transactions. Works with national standard setters to promote convergence of accounting standards. The IASB is funded by the IFRS Foundation, a non-profit organization that oversees its governance. B. IFRS Foundation and advisory bodies. The IFRS Foundation supports the IASB's work and ensures IFRS standards are developed with input from stakeholders. It has 3 key advisory bodies. IFRS Advisory Council provides strategic advice to the IASB. IFRS Interpretations Committee clarifies how IFRS should be applied in specific situations. Monitoring Board oversees the governance of the IFRS Foundation. These bodies help maintain the credibility and effectiveness of IFRS globally. C. National regulatory bodies. Each country has its own regulators responsible for overseeing IFRS adoption and compliance. Examples include Financial Reporting Council, FRC, UK. Securities and Exchange Commission, SEC, USA. Australian Securities and Investments Commission, ASIC, or Australia. While some countries fully adopt IFRS, others modify it or use local GAAP. D. IOSCO, International Organization of Securities Commissions. The IOSCO plays a major role in global financial market regulation. It works with securities regulators to ensure high-quality accounting standards, such as IFRS, are used. Promote investor protection by enforcing transparent reporting. Encourage cross-border cooperation to combat fraud. If a country follows IOSCO's recommendations, its financial markets are more credible to international investors. 3. IFRS versus local GAAP. The role of convergence. Many countries use to have their own generally accepted accounting principles, GAAP. However, to reduce differences and improve global consistency, efforts have been made to converge local GAAP with IFRS. Benefits of convergence. Makes financial statements more comparable across countries. Reduces reporting costs for multinational companies. Increases investor confidence in global markets. Challenges in convergence. Legal and cultural differences. Some countries have laws that conflict with IFRS principles. Economic environment. Different business practices may require specific accounting treatments. Taxation differences. Some tax systems are linked to financial reporting, making IFRS adoption difficult. Example. The European Union, EU, has fully adopted IFRS for listed companies. The United States follows US GAAP but works with the IASB to align key standards. While IFRS adoption is increasing, full convergence remains a challenge due to differences in regulation and business practices. 4. Compliance and enforcement of IFRS. IFRS is not legally binding. Its adoption depends on each country's regulatory authorities. However, enforcement is crucial to ensure companies follow accounting standards correctly. Enforcement mechanisms. External auditors ensure financial statements comply with IFRS. Regulatory bodies monitor and investigate non-compliance. Sanctions and penalties. Companies that fail to comply may face fines, reputational damage, or delisting from stock exchanges. Example. In the UK, the Financial Reporting Council, FRC, reviews financial statements and can fine companies for IFRS violations. In the US, the SEC enforces financial reporting laws and can prosecute companies for misleading investors. Without strong enforcement, IFRS compliance would be meaningless, as companies could manipulate financial results without consequences. 5. Why does the regulatory framework matter? The regulatory framework ensures that financial information is trustworthy and useful for decision-making. It benefits investors, helps them make informed investment decisions. Companies, attracts international investors and reduces financial reporting costs. Governments and regulators, helps maintain financial stability and prevent fraud. A weak regulatory framework leads to loss of investor confidence and financial instability. Test your knowledge. Multiple choice questions. Q1. What is the main role of the IASB? A. To enforce IFRS compliance in member countries. B. To develop and issue international financial reporting standards, IFRS. C. To regulate auditing practices globally. D. To oversee the preparation of financial statements. Q2. Which organization plays a key role in promoting high-quality financial reporting and investor protection worldwide? A. IOSCO. B. IFRS Foundation. C. FRC, Financial Reporting Council. D. IASB. Q3. What is the purpose of convergence in financial reporting? A. To simplify IFRS rules for small businesses. B. To align IFRS with local GAAP, Improving global consistency. C. To eliminate all differences between IFRS and GAAP. D. To allow countries to develop completely separate financial reporting rules. Leave your answers in the comments. Like this video if you found it helpful. Subscribe for more study content on ACCA, IFRS, and financial reporting.